Hey, this is Pam. I work at the Community Land Trust Association in West Marin, and we're going to talk about how to know when you're mortgage ready. I want to share a few slides with you that will help you kind of get a sense of what we're talking about today. And I think the first thing we want to do is just know when you're going to be mortgage ready. We want to talk about income, debt, and then credit. So the first thing with income, you want to have 2 months of pay stubs available and 2 years of tax returns of documented income. And that's how you're going to know that you're mortgage ready on the income side. In terms of debt, any debt you have will decrease the amount of mortgage you can qualify for. So ideally, you're going to pay your debt down to zero. If you can't, make sure it's less than 10% of your gross monthly income. For anybody out in West Marin that's trying to buy a house, we know it's a struggle, and you really do want to reduce that debt now to prepare for home ownership so you can qualify for the most amount of mortgage possible. And then on the credit side, what we want to do is increase our FICO credit score. There's 3 credit reporting bureaus, and they're going to do a tri-merge report of all 3 when you go to get a mortgage. For right now, I just want you to look at your Transunion credit report and score. The Transunion score will generally be your middle score, and you want it to be about 680 or above to know when you're mortgage ready. Ideally, you'll have 3 trade lines open. Think of a trade line as a credit card. You want to have 3 credit cards open for 12 months or longer, and then you'll be ready on the credit side. If you don't have great credit right now, when you're looking at your TransUnion credit report, I'm going to have you do a couple things to improve your score pretty quickly. One thing is you're going to pay every bill on time for 12 months. So any debts you have, you want to pay those on time for 12 months. You don't want any lates going into getting a mortgage. Then you're going to decrease the amount you charge on each card. You never want to charge more than 30% of your credit limit. And that means if I have a credit card with a $300 limit, I'll never charge more than $100 on that card to get maximum score. And for this process right now, leading up to being mortgage ready, we're going to decrease our debt to build our credit score quickly. Pay off any balance you have at the end of the month, and make sure you have 3 trade lines open or 3 credit cards open for 12 months or longer. If you aren't able to get a regular credit card, there's still a way that you can get some help. What you'd want to do is open a secured credit card. A secured credit card requires a deposit when you open it up, and that deposit will get refunded to you if you use the card well. It generally takes 6 to 12 months to come back to you. And it's okay to have 3 secured credit cards, but in general, we want 3 trade lines, whether they're credit cards or secured credit cards. That's how we'll know we'll be mortgage ready. So we looked at income, debt, and credit. And that'll give you a general sense of what you're supposed to do to be mortgage ready. I think those things will really help you prepare, and you really want to be thinking about getting those done early. The more you reduce or improve your credit score, it reduces the amount of interest that you pay, and that's going to improve the amount of mortgage you can get. Next thing we want to talk about is just market rate ownership. If you're out in the market, there's kind of pros and cons to market rate ownership. And probably the most important one is that it's going to build equity for your family the fastest. So you're going to increase in equity, or the difference between what you owe on the house and what it's worth is going to increase dramatically if you're in the open market. And generally, you want to do that if you can. So if you can buy into the open market, especially out in West Marin where it's really tough, that's a great way to build equity quickly. There's no income or resale restrictions. You can just sell it to the next buyer that's qualified when you do want to sell. And you don't have to take any classes or learn to do anything different. You just qualify for it and go get the house. Generally, there's some negative sides to that. In general, if you're qualifying for the maximum amount of mortgage you can, you might risk foreclosure. Obviously, market rate ownership kind of contributes to gentrification. Folks that can't afford to buy are kind of forced out or move further and further from places where they're working and going to school. And then you can't really access that equity generally until you sell the home. So those are some struggles kind of between market rate ownership. I did want to give you a sense of what it would be like to buy something in West Marin right now. So the cheapest house today on Zillow, as I look in West Marin, might be out in Inverness. It's a 1 bedroom, 1 bath. It's about 900 square feet, and it's $930,000, so just under $1 million. To do this in regular market rate ownership, you'll want to save up about 20% down. In this case, it's about $186,000. When you buy this home, your payment will be about $52,000, 5,273 a month. That'll include principal, interest, taxes, and insurance. And your mortgage will be about $744,000 once you've paid your down payment. To be able to qualify for this, your household income will need to be about $15,833 a month, or about $190,000 per year. So if 2 wage earners were working full-time, 2,080 hours a year is full-time, and you each make about $95,000 per year or $45 an hour, you can qualify for this $1 million home that's 1 bedroom, 1 bath. To prepare for ownership, you would want to improve your credit score and decrease your debt to get the maximum amount of mortgage you can. So that just gives you a sense of general market rate ownership, and also how to know when you're mortgage ready. So for a lot of us, we might consider other options to market rate ownership if we don't think we can qualify for that.